Understanding gamma is a critical part of understanding how to manage vertical spreads properly. Gamma measures how quickly delta changes when a stock moves. Remember that gamma is highest on options that are close to expiration. In vertical spreads, there could be a temptation to hold until close to expiration or even through expiration. We call this a potential gamma trap. What beginning traders often don't understand is that the focus on gaining a little bit more profit comes with a lot more potential risk. There are a few dangers that come with holding through expiration. First is a diminishing return on risk on profitable trades, which we discussed in the vertical management videos. Second is the danger that comes with potential exercise. And third is the higher probability of maximum loss in the trade. To understand these risks, it's important to understand that the closer you get to expiration, the less extrinsic value there is remaining on the option. Options with less extrinsic value relative to their intrinsic value are more sensitive to price movement. This means that if there's a sudden price change close to expiration, there's no time value remaining to offset the impact of that price change. And there's also little to no time remaining for price recovery. Let's look at a visual example to demonstrate this. This is a profit and loss graph of a bullish vertical income spread. It shows how much we can make or lose on a trade at expiration. This example has a maximum reward of $1 and a maximum risk of $4. Well, that's a return of just over 25% in 1 month. As you can see, this trade would be at maximum loss if the stock were to fall anywhere under the bought strike of $294. Let's compare it to a profit and loss graph that shows us 2 days prior to expiration. As you can see, 2 days prior to expiration, the stock would have to drop to approximately $280 for the trade to be at maximum loss. Now that's a huge difference. Well, let's see what that looks like on a chart. At expiration, anything under the green line would put this trade at maximum loss. If you exit 2 days early, the stock would have to drop below the red line for you to experience a maximum loss. As a trader, your first concern should always be capital preservation. In other words, don't lose money. Something as simple as planning to exit a couple of days prior to expiration can go a long way towards helping you achieve that objective.